I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, thanks for having me. It's great to talk with you.
Are people calling you up worried about gold right now?
Well, it's funny you ask that because I have actually gotten, not phone calls. I actually got phone calls. I don't really get phone calls very often because the only people that know my phone number are people like you and personal friends of mine. I got lots of phone calls, though, the very day the market bottomed in January when the Dow, I think, was down 500 points during the day. But I have gotten a big pickup in emails the past, 2 or 3 days when they kind of went away for a little while about gold because gold's been pulling back. And if you go on gold websites such as kitco.com, which is one of the top gold sites, or go to HowStreet.com, you can actually get some even better commentary there. But if you go to Kitco, you'll see lots and lots of articles of people calling for pullbacks and corrections and where's gold going to fall to and this and that, and nobody's calling for it to go up immediately or really even saying that this is a good buying opportunity. In reality, I heard someone recently told me that when someone has their money in a financial market, whether that's the stock market or gold, that their money's at risk, and it makes them want to see what's happening every single day and then try to understand what's happening. In reality, in any given day, there's almost never anything that important happening at all. And if anything, you can get misled by what you're seeing and fooled into doing something. And I think that's, what I fear is happening to lots of people doing trades today, whether it's for gold or the stock market. With gold, we have had a pullback. It's not really been much of one for gold itself. It went up to it had resistance at 1290 and approached that level and then got down to 1220 or something. It's a 70-point swing. It's not really that big of a deal when, it started the year out below 1100. But the mining stocks, they did have a sharp pullback. They were down one day. The GDX gold stock ETF, which I do own, it was down like 7%. I think it was Wednesday last week. But that move has to be put in context with the fact that it's gone up over 100% since where it was at its low in January. And I really believe we're in a big bull market, just the start of one. That's why it went up 100%. And gold and GDX and the individual mining stocks, all of them went up so much that they broke away from their 200-day and 150-day moving averages. Those moving averages are still fairly far away, and they're all sloping up. And often when you see something like that happen, that move that powerful to start a bull market, you can get a move for 12 months that's so big by the end of it, people can hardly believe it. But during the move, you'll get sharp pullbacks and pauses that last a couple days or even a couple weeks. So that's what I think we've pretty much seen, and I think we've pretty much gone through the depth of the drop, most likely. The GDX and the other gold stock ETFs, they went down to their 50-day moving averages and held them, and they're bounced back above them today. So I think in gold itself, it probably has support at 1,200 or 1,190 at the very most, which isn't that very far from the low of this morning. So I don't really think there's much downside in regards to price, and that would make this a good time to buy. However, I can't really predict the time factor, which is also very important. How long will it take before the gold stocks make a new high? I don't know if it'll take a couple weeks or take a couple months. It could take 3 weeks up to 3 months. So that part's impossible to predict, but what I can say is once it does make a new high, I would expect it really to go up tremendously like we saw it do in February.
Some people have told me because there is so much weight put on the Dow Industrials, it totally distorts what's really happening in the market for real.
Well, it does nowadays, because when you're early in a bull market cycle, like the stock market was in 2009, or like gold is right now, what you tend to see is buying across the board in all stocks. Huge volume coming in, huge price advances. So if you look at gold stocks, that's really what we've seen this year. Yes, the ETFs have gone up 100%, but there's also been tremendous buying on the Vancouver Stock Exchange. And that buying is really professional money going in there. I haven't gotten any flyers in the mail for like 2 years about, with a penny stock promotion for some mine in Africa, let's say. So the little people aren't buying this stuff. It's really the pros. Everyone kind of trades the ETFs, but as far as small cap stocks, it's really people who know someone in the mining industry, or or like an analyst in the mining industry, and can tell where the value is, and that kind of business. The general public won't get into it really for another year or two, but a small segment of the general public will trade the ETFs, or are trading the ETFs, and some of the big cap stocks in the United States. To flip this though to your question with the Dow, is in the United States stock market, the Dow has become so important, and the S&P 500 also, and the NASDAQ, but now it's really the Dow that's becoming the only story just about, because the bull market started so long ago that we no longer have across the board buying in all stocks at all. When the stock market goes up, many stocks don't even go up with the market, and it's just very selective, the actual buying that's taking place. Only a few stocks are on their highs, even with the Dow and S&P 500 near them. And it's even, we talked about this happening last July and in the fall too, November, December, when you get the end of a bull market or the end of a rally that's late in a bull market. What happens is it's only a few stocks going up, and many stocks all go into bear markets already, and they just kind of die out. And that's really what's going on. So many stocks in the last quarter of earnings just got hit after the earnings reports and fell really bad. And it's still happening. So what's going on is when you do have a up day or a positive day in the stock market, many people are just buying the exchange traded funds. The typical investor is just chasing them and playing the ETFs, and stocks that aren't in these ETFs hardly ever are getting bought or getting real bids, and that's the opposite of what we're seeing in gold. So my interpretation is in gold you have real money flowing in there that's doing real investing, but in the stock market everyone's already in it that's ever going to get in it, and they've been in it for over a year, and they're not making any money for the most part because the market hasn't done anything in all that time. And the active trader person or the maniac that is fully invested and then goes on margin to gamble up and dreams of some giant short-term run happening, they basically just pile into the exchange traded funds. If you go to stockcharts.com, you'll see every single day a list of the popular tickers, the most typed in, the most being traded, and they're almost always the same ones: Apple, Amazon, Google, and then the triple ETFs, where the gamblers love to gamble, and sometimes the Dow and the SPY ETFs. But when someone buys, let's say, the Dow ETF, they're buying all 30 Dow stocks, and ignoring the entire rest of the stock market. And one of the best examples of this, to explain maybe what's going on more clearly, if you look at the biotech sector, there's a biotech ETF, BBH, which has several dozen biotech stocks in it, but the sector itself consists of about 300 stocks, and those stocks that are not in the ETF have not been able to go up since the market put in its low in February, and they're not even getting any volume. They're just sinking or just sitting on their lows and languishing. And that's what's going on with much of the U.S. stock market, or that's a good metaphor for the whole thing.
We'll have more with Mike Swanson right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, is China doing better than many people suspected? Because we know a stock market isn't always an accurate indicator of how your economy is doing.
Well, that's right. A lot of times what happens with the financial market is it gets overvalued and undervalued. And when you, at the end of a bear market, companies and can be priced as if they're going to go bankrupt by their stocks because they fall so much. There's no demand, and no one's interested in buying, and stuff just sinks. But in bull markets, you can have the opposite situation, which is basically what happened to China a year and a half ago. Their stock market went up about tripled in like 6 months and made a massive bubble. The bubble popped almost exactly a year ago, and the stock market fell 50%, but it's still wildly overvalued. Now, there is definitely a slowdown in China from where it was a year ago, but whether that's a Great Depression or I don't see that right now. I don't even know if it's having negative growth, but it's definitely slowed down. But the thing, if you're looking at the stock market, it's done so bad simply because it went up so much. In the United States, we also face a similar problem. Obviously, the economy in the United States is not booming and hasn't boomed in a very long time. And there's been no great economic recovery in most of the country since 2009. Yes, Washington, D.C. has boomed. There's no denying that. The growth of government and the continual wars has created a boom in the defense industry, and also the homeland security industry is really done well. In other small segments of the economy, in some pockets of the country, but the country as a whole, wages have been stagnant. Real unemployment hasn't really improved that much. And you can see that in the younger generation, the people that get out of college. I just read a story today that said that more people around the age of 30 now live with their parents than live with a significant other or married because the economy is so bad. And yet, the stock market has done so well since 2009. Why is that? And that's a real important thing to ask yourself, because if you look at valuation metrics such as the cyclically adjusted PE ratio, which takes the S&P 500's P ratio and adjusts it for inflation over 10 years and smooths it out, it's only gotten as high as it was a year ago, in 1929, 1987, and in 2000. So none of those are good times to buy, and it just tells you how overvalued the market was, but it hasn't crashed yet, so people say, well, I don't care about that until it does fall on them. The key, though, question is, why did it go up? In 1999, the market went up because we had a massive speculative bubble in Internet stocks, thanks to the fact that Alan Greenspan lowered interest rates in a panic to bail out a hedge fund in 1998, the Long-Term Capital Fund. he created a bubble as a result of that operation, and that bubble burst and caused a lot of pain for people who got caught up believing it was real on their own foolish fault. And then he lowered rates again, created a real estate bubble that culminated in the banking crash of 2008, and then they lowered rates again and created the quantitative easing money printing program to help the banks. But that created another bubble that people don't want to talk about, a bubble that some people are using right now to exit and take advantage of the general public who doesn't know what's happening. And that's a point I really want to make, and explain it with a simple example. The bubble is in junk bond debt. By putting interest rates to zero, there's been a record issuance of junk bond debt since 2010. And companies have used that debt not to invest in new operations or grow their businesses, but to buy back stock. That's what created the stock market boom. Now what's been happening is that some companies have been destroying their balance sheets, going into debt to do this, and the insiders of these companies are now exiting, selling stock, taking advantage of the elevated stock prices in the general public that will eat up the stocks or have money managers that will do it for them or mutual funds. And we saw an example of this sort of nasty business last week in Target, the retail giant in the United States. The earnings were terrible. But what happened with Target stock is it topped out a year ago, it underperformed the stock market, became a nasty stock for a portfolio manager to own, and did really terrible in January. But then the stock had a magic turnaround and went up almost 50% in 90 days. The way the Target management did that was by borrowing money from using the junk bond market to borrow massive amounts of money in 3 months. More money than they've ever borrowed in an entire year before in the entire history of the company. They used that to do massive stock share buybacks to boost the stock. And while they did this, around March, they just dumped and dumped and dumped. The Target CEO dumped many shares. So did the other board of directors. And then last week, the company announced terrible earnings, and the stock crashed. And the small fry got left holding the bag. Well, anyone listening to this can go to Yahoo Finance and look at the balance sheet and look at the statistics, look at the insider selling, see this for themselves. But then they should do something after that. I have no position in Target. I'm just using it as a lesson. What they need to do after that is look at the stocks that they own themselves and see if similar activity has been taking place. Has the balance sheets been destroyed by junk bond debt issuance? Have the insiders been selling? Apple insiders have been selling at 16% of their holdings since July last year, dumping like crazy, and the stock is acting like a laggard while people hold the bag. And no one's making money in it anymore, unless they bought 3 or 4 days ago for a short-term bounce. But that's just one stock. Everyone should check their holdings. Do the homework. Do the homework to see what you own is good or not. Are the people running the companies or the stocks you own looking after your interests and the long-term health of the company, or are they just creating a stock market game and cashing out and running all the way to the bank? That's what so many of the J.P. Morgans and the Goldman Sachs and all those banks that everyone hates that screwed us all in 2008 did. They took advantage of the situation to make massive amounts of money, and they took their bonuses, and people got really angry about it because they lost money, and then for a couple of years, the banks became demons and this and that. All that might be true, but at some point you've got to take personal responsibility for your own investment decisions and analyze what you're owning. And so I'm just asking people to do their homework on what they own.
Mike, what about other markets outside of North America? How are they doing?
Well, pretty much. It's quite interesting because if you look at the European markets as a whole, they're lagging the United States, and so have emerging markets. And it's kind of a curious thing because these people in Europe and also Japan, they've tried to do similar policies as we've done over here by doing the quantitative easing and trying to encourage companies to go into debt to buy back stock and this and that, but it hasn't really worked. Now, today, the Greek stock market's done well the past couple of weeks because they've made a bailout deal. But so far at this point in time, as this year has been going, the United States, really the Dow and S&P 500, have outperformed these other markets, and actually gold and silver have outperformed everything. And soybeans has done really well, a couple of even commodities, but the gold has really been the best performing thing. However, I do have my eye on hoping to invest in some markets outside the United States at some point in the next, probably within this year, 12 months or something. I'm looking at the Russian stock market in particular because it's got a very low valuation. It's already had a big bear market. It's just going through what I call a stage one basing phase. The financial market of Vietnam also has a very low valuation, and it looks very interesting. But I'm just being very patient about that. I'm just watching these things, and I would really like to see a stock market drop in the United States, and which would impact the rest of the world, and see if these things hold up. Because that, if they do, that would make for a great buy signal and an entry point and so forth. But it might not be until the fall before there's a real big enough drop to cause people to get scared like they did in January or last August.
Mike, thank you very much for chatting with us.
Thank you. It's great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments or questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.